Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and welcome to our third webcast. I have Andrew Chang and Jesse Vandermeer also with me, and we looking forward to updating you on our views on the market and also several of our holdings that are important contributors to the performance in our fund. So there is a presentation linked to this webcast right below when you enter into the YouTube channel there. And you can click on that and then follow along as we go through the slides. I'm going to go over to the slides in a few moments, but let me just give you a couple of quick intermediate comments here in terms of just starting things off. First of all, in terms of our outline of our presentation, we'll talk a little bit about our investment philosophy very briefly. It's important that we always anchor our investors in how we approach investing. Going to talk just again very quickly about some of the challenges that we're facing, particularly the falling interest rates, which is what we've called this presentation. And then a few portfolio highlights. We've actually done a little bit of trimming in the portfolio. We'll just talk a little bit about that, update you on our performance, and then I'm going to hand it over to Jesse and Andrew to talk about two of our core holdings that are important to our portfolios. So in terms of ROCKLINC overview on the fourth slide, in our presentation to just give you a quick overview of our business, and I'm not going to spend any time on that. It just highlights that we're now approaching about $140 million in assets, about 120 families, and our focus is on customized portfolios. We want to be differentiated. We do not want to invest just the way everybody else is investing out there. We want to think in a very disciplined, long-term manner in terms of our investment philosophy. And on slide 5, we just highlight, in terms of our investment philosophy, what are some of the key components of that? And you're going to hear about some of the businesses that we own, and hopefully those businesses should fall within these type of parameters. They're excellent companies. We run focused portfolios, businesses that we can take a long-term view on, businesses that we can buy at reasonable prices. We call that a margin of safety. That's very important in this market because the market overall is quite expensive. It's not a cheap market. It's not easy to find good values, and so we have to be very careful. And we also then want to understand the economic backdrop, because whenever you're buying an individual business, it has to be placed within the context of the economy and the challenges that the economy is going to provide it with. And so we're always thinking about the big picture and then zeroing in on great companies that should be able to navigate the challenges of the overall sort of macroeconomic environment. Now I'm going to just swing over to the slides now. So what's going to come up with the slides, and I'll take you through the remainder of the slides that I'm going to cover before we come back to Jesse and Andrew. So let me just hit the share here. There we go. Okay, and then I'm going to fast forward through the slides. Okay, investment challenges. Now this is similar to what we've talked about in the previous two webcasts, and I just want to reiterate again these points. Number one, the debt situation. It's really out of control, and this is one of the reasons why interest rates cannot go up very much. In fact, why interest rates have come down. So I just want to emphasize again, when we're making investments, we're always making it in the backdrop of way too much debt, corporate, personal, and also sovereign or government debt. We're also very conscious of the government promises. The government has made all sorts of social programs that they've promised where they haven't funded them. And this is becoming a bigger issue as the days and months and years go by. The demographic challenges, which most of you are aware of, we do not have, the lack of family formation, the lack of another generation being produced. In fact, quite the contrary. We actually have a culture that includes a focus on abortion, on euthanasia. If anything, it's really much more of a culture of death, not really a culture of life. This is a big concern. You cannot have vibrant economies and viable economies if you don't have a focus on families and producing another generation. And then the monetary policies, I don't have to tell you, we've emphasized this. We've gone through a lot of printing of money, record low interest rates, which they call quantitative easing. And then more recently, if we were to go back to, say, 6 months, 8 months ago, everybody was talking about quantitative tightening, how we're going to pull money out of the system, we're going to reduce our money printing, and we're going to increase interest rates. And we've told our investors for 5, 6, 7 years it's impossible. Central banks, it's easy to print money, it's easy to drop interest rates on one hand, but those are policies that are really one way. It's very difficult policies to extricate yourself from. And that's because the global balance sheet is way too over leveraged. So there's much too much debt. And so it's going to be very hard to put interest rates up. And that's why we've entitled this presentation, Dropping Interest Rates and Falling Interest Rates. And so on the next slide, key implications when it comes to investing, which we again talk to our investors over and over again. We really try to drill this in. We think it's virtually impossible for central banks to get out of this cycle that they've entered into, which is printing money and keeping interest rates very low. We think it's impossible that interest rates can go up very high without bringing on an economic recession and potentially a depression. We favor, therefore, hard tangible assets in light of that, because if we're concerned about the economy and the inability to put interest rates up and the fact that central banks are going to continue to weaken our purchasing power of our money, then we want to buy assets that will protect our purchasing power. So tangible, hard assets, essential assets, scarce assets, businesses with proven business models. And that's what you're going to hear about today, a couple of companies that fit that bill. We also maintain a healthy exposure to monetary substitutes like gold and silver. Currently, 4 out of our top 15 holdings are gold and silver royalty companies. And I suspect that over the next number of months, probably 4 of our top 12 holdings will be gold and silver, because we're continuing to add to our positions carefully, because we see this as a big opportunity if there's financial dislocation in the market. And we love these businesses. They make money year in and year out anyway, the royalty companies. And we've talked about that to our investors before. And then keep some firepower on the side to take advantage of market volatility, some cash, near cash, short-term bonds, things like that, because if the market gets crazy, as we saw last fall and into the fourth quarter of 2018, then we can strike and get some great deals. On the next slide, I just highlight this issue of crashing and falling interest rates. This is the 10-year US Treasury. And you can see that about a year ago, this is just the last 12 months, it was around 3%. It actually peaked up over 3.2%, 3.25. And that wasn't that long ago in November. Everybody was talking about interest rates going up. Interestingly enough, if you follow that curve down, you can see that today, we're actually at the same level we were back on last Friday. We're at 2.08% on a 10-year Treasury. And you can see from April and May that curve just went straight down. And that's this whole concern over the fact that rates cannot go up. And the Federal Reserve in the US has gone from a position of we're going to increase interest rates, and you wonder again what planet they're on, to all of a sudden, oh no, we can't. And we might actually have to decrease interest rates. And so you've had this major shift take place just in the last number of months. And this is just the 5-year Treasury, again, just to give you an example of how close the interest rates are between the 5 and 10-year. It's at 1.85. But again, it's the same trajectory. It came up last year, late last year, and all of a sudden the impact of interest rates started to be felt in a very highly leveraged global balance sheet, and they had to back off. And so we've had a large drop in interest rates. Now, a lot of people think, well, isn't that great? But the reason interest rates are falling is because the economy cannot withstand higher interest rates. That is not a long-term positive. It's one that we need to be concerned about, and we need to focus on when it comes to investing your money if we're going to protect your capital. The next slide is, I think, quite interesting for you to just take a second and let me explain quickly what we've got here. We've got the 10-year government bond yields across a number of key countries or industrial nations. So if you start at the top, the US, 2.08. Canada, our 10 years, 1.46. Our economy is much weaker than the United States and cannot take the same level of interest rates, or we'd be in big trouble here in Canada. Also, we need a lower dollar to compete with the United States. So the Bank of Canada keeps our rates lower than the US so they can keep our dollar cheaper. Now, if you go over to Europe and you think of Germany and France, Switzerland, or I should say Sweden, Germany, France, and Sweden, you can see that the 10-year yield on the German bond is 0.18%. That means each year you're earning 0.18% if you buy a 10-year German bond. I mean, virtually nothing. France is actually a bit lower, if you can believe it, even though France is a riskier economy. And that's, of course, those are denominated in euros. Sweden's only 5 basis points per year. So this is telling you that over in Europe, they can't even have, they can virtually have, can't even support any interest rate. If you go down to, let's skip the UK for a second, go down to Switzerland, you can actually see if you are buying a Swiss bond, so you're getting Swiss franc, the actual return is a negative 0.5% a year. So over 10 years, you're going to average a negative return if you buy a Swiss bond. That's telling you that really there's big trouble. Now, if you go to Japan, interest rates 1 year, 2 year, 5 year, 10 year, they're all negative. And Japan is talking about even more money printing and trying to get rates even lower, if you can believe it. The UK is sort of right in between North America and the rest of Europe there at 0.81. I point that out because in our view, US rates and Canadian rates, if anything, are more likely to trend down towards the European rates than they are to go up, because the European rates aren't going anywhere, if not down. If they're going to go anywhere, they'll be down. So this tells us, again, we must be very careful as investors. This is a very risky market that we're in. Just quickly, a couple of the last slides that I'm going to speak about. We did make a wholesale sale of Oracle. We sold it across our book of business. We hadn't added any Oracle for the last year, and most of our clients were up about 100% on Oracle over the last number of years that we've owned it. But we sold it just, we've got a number of the reasons here. Just very quickly, its core business is not growing, virtually not growing at all. Very slow growth in its core business databases, and it's losing market share. Since 2011, it's lost about 7% of the market share to competitors. In the cloud business, which is masking some of their problems because the cloud business is growing quickly, they're also growing that business, but not at the same rate as Amazon, Microsoft, Apple, and so on. So that means that they're growing, but they're still losing to very large, respected key competitors, which is not good. And then the company, since 2012, has spent over $92 billion in cash to repurchase 1.5 billion shares, or about 30% of the company. And so we're thinking, this is a company that really can't put its cash to work, at least it's not deciding to do that, into areas to really grow the business. And the business is really stagnating with, less than 2% reported revenue growth on average over the last 5 years. So we just thought, we've done very well. We can find better opportunities, and so we moved on. And then the last little point there on this particular slide, we had a couple of companies that were spun out of Honeywell, which is a big holding of ours, called Garrett Motion and Resigio Technologies, and we just eliminated those just because they were small positions and they're not something. Neither company was one that we were going to create a large position in, so we cleaned those companies up. The next two slides you can just look at again at your leisure. It's just a performance as of the end of May. This first slide here is sort of our balanced fund. It's our whole book of business, and this is after all expenses. And so you can see that, say, over the last year, we've averaged 10.3% on our book. Over the last 5 years, 7.3%. And that's a mix of 68% equity, 32% bonds. And then this slide just looks at our 100% equities. How have our equity selections done vis-a-vis the TSX the Toronto market, and the S&P 500. And you can see that we've been pretty consistently ahead of the benchmarks. And so we're pleased with that, especially given the conservative nature and the high quality nature of our portfolios. So with that, I'm going to turn it over to Jesse Vandermeer, who's going to start to talk about several companies that we're going to highlight. Roper, and then we're going to turn it over to Andrew to talk about Church & Dwight. So Jesse, over to you, sir.
One of those high quality components to the portfolios that we have is Roper Technologies in client portfolios. Roper Technologies is an acquirer of niche software companies. They maintain a portfolio of 45 independent operating companies, and these companies offer specialized software targeted towards a specific application or end market. And these usually are niche applications and end markets where it doesn't make sense for a competitor to enter into and offer a competing product. These software companies provide services to a wide variety of end markets, including healthcare, transportation, law, water, and many more. And this not only helps to diversify the revenues by end markets, but also by geography. Roper Technologies has evolved as a company from industrial product manufacturer. So they used to produce things such as pumps and analytical instrumentation. And they've really shifted over the years their portfolio to focus on technology and being a software provider. There's a number of reasons why they have done this, and the same reasons why we're attracted to the business. They have high recurring revenues, which provides stability. As investors, we like to see that. They have high margins, strong and intimate customer relationships, back and forth. There's an open dialogue, fine-tuning it so they can offer the best software and service to their customers. There's enormous operating leverage, which is fantastic. There's high margins and a low variable cost, so this helps boost margins over time. And lastly, it requires minimal CapEx. There's a fixed cost base, and this also helps aid in boosting free cash flow, which is one of the key metrics that we look at when we look at a company. On the slide, if you have it in front of you, I have in quotation, software is infrastructure. When we think of infrastructure, we typically think of hard assets such as airports or toll roads or a hydro dam. But in reality, if you think about it, software is an essential component to run your business, much like hard asset infrastructure is. So software has become embedded in the day-to-day operations of many of these businesses and is critical to the functioning of it. And in many cases, if it's not irreplaceable, it's very, very hard to switch easily, which again aids in the retention and strengthening of the customer relationships. And then lastly is capital allocation. This is a key ingredient to the success of Roper over the last couple of years and really decades as a company. They are very able in their capital allocation acumen. They have strong criteria for acquisitions, must meet certain benchmarks, and it has really led to a fantastic compounding effect. Over the period of 2003 to 2018, Roper has produced a compound annual rate of return of 19% versus the S&P's 9% over that same period of time. So that really manifests Roper's capabilities and able to prune and acquire high quality businesses. And we all, as shareholders, benefit from this mutual fund of really high quality businesses that they've managed to cobble together over the past decades through careful criteria and acquisition and pruning of that portfolio as well. So we're not constrained by geography, industry, or end market. I'm going to pull up a slide now onto the screen, and this really demonstrates the capital allocation I'm talking about. We have Roper Industries there, that blue line, and a company we're all quite familiar with, GE, in the orange. And you can just see the jaw difference between those two businesses. From the period of January 1st, 2002 to recently in 2019, Roper has returned over 1,300% in price return, and versus GE's negative 72%. And this really speaks to management's capital allocation over the past decade or so, and you can see that in the shareholder return. Interestingly as well, at the end of 2001, the CEOs of the respective companies were both installed at that time. So it's interesting to see the dynamic of management as well. So that's been extremely interesting. Moving to the next two slides, I'll just talk a little bit about the business segments. And Roper organizes its segments by business model and not the end markets. Because they have so many operating companies underneath them, I'll just highlight two companies for each segment to give you an idea of what's involved in those segments and businesses. So the first segment we see is application software. This segment deals with enterprise software that is specifically designed for one application. So for the first company, this is software designed for law firms called Adorant. And they manage things such as business development, calendar and docket management, billings, case management, and document management. These are items that wouldn't be covered by a general enterprise software program, and really speaks to the specialization of the software that these companies provide. And law firms are loath to change systems, especially if it's embedded across the whole business. The second company you see there is Deltek, and this is software provided for project-based businesses. And specifically in government contracting, actually, Deltek is used by 99 of the largest 100 US federal prime contractors. And this is because the government, if you're a contractor for them, there's various regulations. They manage unique aspects such as compliance requirement, documentation, and just an alphabet soup of invoice formats. So Deltek really provides project-based software specifically for government contractors. In the second segment, we see network software and systems. This is software that brings together many different players and creates a network effect. So with Construct Connect, if you're building, if you're in the construction industry and you're looking to build, office tower or residential buildings, you can bring together all the players involved, the contractors, subcontractors, designers, and architects. And this really increases efficiencies, and they can choose, prepare, and evaluate the project before they build. Along the similar vein, we have DAT Solutions, and this is another network software network that is used for freight spot transactions. So if you're looking to ship some freight, you can connect with the available drivers, and they connect with the freight load. So this increases efficiencies, brings down the price, and also this network increases as participants join the network, and really speaks towards the efficiency that a software like that can bring. Now, these last two segments, they are smaller and they represent Roper's legacy businesses, but still high quality, and part of the reason why they maintain them. In measurement and analytical solutions, you see Neptune. They are a pioneer in the development of automatic meter reading, and they collect their data collection systems are used to read more than 72 million meters per month. They've taken a traditional product, analog water meter, and have created a connected water system that increases the efficiency and can also detect water leaks and measure usage remotely, which of course saves money and increases efficiency. With NDI, it's electromagnetic measurement systems used for the critical growing field of computer-assisted surgery. So a fantastic end market and a rather niche product. In process technologies, again, a second portion of the legacy business, but still enjoys high returns of capital due to a strong installed base and has high margin recurring revenue through parts and services. With Cornell, they manufacture highly engineered pumps used across many essential industries. And with AMOT, they provide control, safety, and solutions for engine compressors and turbines used in the power generation and oil and gas industries. So again, Roper, as you've seen, they have a fantastic portfolio of companies that provide specialized software and products and has provided shareholders with high returns on capital and creates an immense compounded wealth creation. I'll turn it over now to Andrew, who will speak to Church and Dwight.
Great, thanks so much, Jesse. One of the industries that we cover is the consumer packaging goods industry. And this industry is dominated by many large players that compete in a dynamic retail environment. In the past, consumers have a tendency to purchase products and brands that they're comfortable with. We're now seeing a trend in consumers diverging and trying out new innovative brands from emerging corporations. As we start to see these changes in consumer preferences, larger corporations find it difficult to be able to keep pace or meet these changes in consumer preferences. So we start seeing in the merger and acquisition space, more larger corporations buying up these small niche corporations that have higher growth rates. Now, these larger corporations include P&G and Unilever. And one of the companies that Unilever recently purchased a while back is a company called Dollar Shave Club. And this Dollar Shave Club is a direct-to-consumer company that sells something very simpler, razor blades. Yet it's been able to penetrate the market through innovative branding. And consumers are more willing to go direct as opposed to these larger corporations. Another issue with these larger corporations is that they have long brand innovation cycles or reformulation cycles, which causes them to be lagging in the ability to meet consumer preferences. Oftentimes, these larger corporations are a lot more bureaucratic. There's a lot more loopholes in order for these companies to be able to move quickly on the ground. Now, in the midst of the land of giants, there's been one company that's been able to grow at a faster rate than the market, and also be able to maintain its market-leading position. And this company is a company that we own shares of, a company called Church and Dwight. I'm just gonna go to just the slide now, just so you can see some of the brands that this company produces. So Church and Dwight, you may not have heard of the company Church and Dwight, but I'm sure if you looked at your pantry or your laundry room, you might find some of its products. Church and Dwight has a rich history, over 150 years of developing innovative products. One of the products that's very well known is the Arm & Hammer baking soda brand. Church and Dwight produces household products, personal care, and specialty products. Starting with the household products, you see the Arm & Hammer laundry detergent. You see Clump & Seal, which is a cat litter product for those who are cat lovers. We have OxyClean. OxyClean is a whitening agent. Many of you might have seen in the past commercials with the Billy Mace. Extra is a deep discount value laundry detergent. And then Orange Glow, which is used as a cleaner for wooden products. Looking at personal care, some of you who may have had toothaches in the past might have used Orajel to put on your gums. Batiste dry shampoo. For those who do not wash their hair every single day, can use Batiste dry shampoo to keep your hair refreshed and livened. Most recently, Church and Dwight purchased a Waterpik, which produces a water flosser. Now, in the age of dentistry, many The statistics is very low for those who floss their teeth. And particularly, some of the flossing can actually cause damaging to the gums. And so the Waterpik produces a product that is very effective scientifically to clean your gums while making it a lot more easier and more palatable for consumers to do so. Many of us like to take vitamins. Vitamins can often be in the pill form, but recently it now comes in the form of gummies. And this has been making taking vitamins a lot more palatable for adults and children. And also there you see Nair. Nair is a product that's used for hair removal, and there's also a male brand as well. And lastly, we see Church & Dwight produces specialty products. Specialty products are used in industrial applications such as specialty chemicals. There's feed additive for dairy cows to produce more milk. There's leavening agents for commercial baked goods. Some of the specialty products include antacids in pharmaceuticals and carbon dioxide agents and fire extinguishers. And what's great about Church & Dwight is that a portion of its products are premium and a portion of its products are within the discount value brand. About 65% is premium and 35% is value. And this allows this company to be able to capture both markets for those who prefer to purchase more high-end products, and also those who are more likely to purchase more discount products. Looking at the next slide, I have a comparison here between Church & Dwight and a company that many of you are well known, Procter & Gamble. Procter & Gamble is a manufacturer of Pampers, diapers, and also the Tide laundry detergent. And you see from January 1st, 2009 to June 10th, 2019, that Church & Dwight stock has actually gone up 509%, whereas Procter & Gamble has only gone up 138%. And if you look at this chart, you might ask yourself, why is there such a large divergence? P&G, a large corporation, many great brands, yet Church & Dwight has been able to grow its stock at a much faster pace. On the next slide, I'm just going to go over some of the reasons why we invest in Church & Dwight, and also some of the reasons why we believe that Church & Dwight has outperformed many of its competitors. So as I mentioned before, Church & Dwight is a smaller company, has a nimble organizational structure. And what's beneficial about Church & Dwight versus its larger competitors is that it's able to make decisions at a faster rate. It can quickly adapt its market research and make changes to its products at a much faster clip than its competitors, which has to jump through many different loopholes before doing so. Another reason is that Church & Dwight has a proven track record of maintaining or expanding its market share through product innovation. Take one example, Church & Dwight has been able to leverage one of its oldest products, its Arm & Hammer baking soda, and turn it into a $1 billion brand. Now, over the past few decades, the company's branding and marketing efforts has been able to create strong brand associations with its Arm & Hammer baking soda brand. Now, if I were to ask you, when you think of baking soda, what do you think of? Most people often think of the Arm & Hammer brand. Church & Dwight has also been able to instill in consumers' minds that baking soda is natural, it's safe, and it's an effective cleaning agent. This has enabled the company to infuse its Arm & Hammer baking soda brand into many different types of cleaning and hygiene products, such as laundry detergent, toothpaste, cat litter, and deodorizers. Now, Church & Dwight has also been able to innovate many of its other brands. For example, OxyClean. OxyClean is known for whitening products, but it's recently developed a product to help darker fibers become more darker so that it doesn't lose its color after multiple different washes. Arm & Hammer detergent and OxyClean have actually combined together to make more vibrant colors and more brighter colors. Arm & Hammer Cloud Control is a type of cat litter that clumps together when throwing away in the garbage. Many of you who have cats, I don't have cats, but I know one problem is that you have these dust clouds that arise when cleaning out your cat bin. And Vitafusion and Little Critters has been able to innovate by having organic vitamins, putting a healthier option for its products. Now, adding this all up together, this has enabled the company to have 11 of its brands to have #1 market share in its respective category. 11 of the 12 power brands generate over 80% of the company's sales and profits. Some of these examples include Arm & Hammer baking soda. It's the #1 baking soda. Batiste is the #1 dry shampoo. Vitafusion and Little Critters is the #1 adult and children's vitamin gummies. And Waterpik, which is the #1 power water flosser. Another reason why Church & Dwight has been able to grow at a faster rate is due to its ability to expand into international markets. Now, many of its brands are based in many of the acquired brands the company purchases are based in the US, but they're able to leverage their scale and distribution into international markets to grow. In the slide there, you see that organic growth in 2018 grew at 7.8%, 2 to 3 times greater than the domestic market. This is all translated into strong financial results. The company has been able to keep its SG&A, or its sales, general, and administrative expense at very low rates because of its nimble structure and its cost reduction programs. This has allowed the company to be able to generate fast free cash flow of 10.2%. Also, the company is very prudent of keeping its balance sheet low with debt, the low debt to equity ratio of less than 1.0. The company has been able to generate high free cash flow, which has translated into a consistent dividend growth. From 2012 to 2018, we see that the dividends have grown at 9%. All of this has translated into that divergence in stock performance between Church & Dwight and Procter & Gamble.
Thank you very much for that. Just a couple of quick questions for Andrew, and then I'm just going to go back to Jesse just to elaborate a little bit in terms of the business model. When you see Church & Dwight, and I've owned that in a predecessor company before I started ROCKLINC in a mutual fund. We've had Church & Dwight for close to 20 years, actually. And again, that the reason being is that they're nimble, they're lean, and they really know how to grow a brand. And they can start with something like Arm & Hammer baking soda with trust and confidence in the consumer's mind, and then do brand extensions in a way that no other consumer discretionary company's been able to do, in my view. And every year, it just amazes me how they continue to evolve. And if you have the trust and confidence of consumers, then you don't have to spend as much money on marketing. And so one of the things that's unique when Andrew looks at the company is that the amount of money that they spend and have to spend on marketing, which can become a very, very large item for companies like Procter & Gamble. I mean, they're just spending a lot of money on marketing and advertising. If you can reduce that by half, then your margins are wonderful, and you can pass that along in lower prices. And so that's really what they do in effect, and it makes it much more cost competitive. So when you go shopping and you're picking a detergent, you're saying, well, I can buy Tide, but I can also buy this product from Church & Dwight with an Arm & Hammer sort of branding on it, and you trust it. And in fact, it is just as good, if not better. and you're buying it at a lower price. And so they continue to do that and innovate. The water pick was also very interesting because they took a brand that a lot of people have heard of, water pick. It's got a piece of your mind. You know it's got consciousness with you, but it's been underutilized. It hasn't been marketed very well. It hasn't been developed. And so they take that at a really opportune time with an aging population, increasing dental costs, and people concerned about their teeth and keeping their teeth in their mouth longer than in previous generations. And they develop a product that's going to go right at that market. And so that's really why we like it, and their ability to reinvest. And they feel pretty comfortable, Andrew, I think, continuing to do brand extensions and find undervalued brands that the big guys often just, they're just too big to deal with them. And so a lot of times they can buy some of these other brands off other larger companies, and then they'll work them. So one of the reasons why we bought it years ago was because we thought it was going to get taken out by P&G, bought out because they were much better than P&G at developing their brands. But they haven't been, and they just continue to grow really well and make lots of money for our investors. So so we're happy with it. So continue to, Andrew, whenever he's researching, it's always happy. When he sees the numbers, he goes, wow. It's just particularly because that's a sector that has not been performing very well, and people are very, very price sensitive. And so we like that. So thank you very much, Andrew. Hopefully that's helpful for our investors in understanding that business and why it's been so differentiated over P&G or Unilever and all these other big companies. Kraft Heinz has really blown up because they're just too big. They're too bureaucratic. They're not innovative. They're not creative in terms of their businesses. So just a quick question. We're just going to shift over, and then we'll end the webcast over to Jesse. The Roper is fascinating. Do you think the company continues to have good opportunities? What have they talked about in terms of further growth? Because they've made a lot of acquisitions in these specialized software areas, and they're very, very careful with how they invest. The company, they generate a lot of free cash flow, which is good news. The bad news is, what do you do with the free cash flow? And so we watch that. Are they disciplined? What are they saying?
They definitely are disciplined. They mentioned in the latest quarter that they have made a recent acquisition. It has to do with design, graphic design. So there are opportunities, but they do mention how valuations are elevated. And sometimes they recognize this very important fact that sometimes it's better not to overpay than to go forward and make all these acquisitions, because over time, if you overpay, you can destroy value. So they are judiciously making acquisitions where they see good value, where it fits within their portfolio, and they're willing to press the brakes a little bit and not go forward with everything that they see if the price doesn't make sense. They also have the opportunity with all this free cash flow to pay down debt, because you have to watch companies that continuously make acquisitions. You have to watch their debt levels, because those can build up. But with all this free cash flow, they're able to pay down that debt. Their debt levels are below 2 times net debt to EBITDA, which is very respectable. That's a good metric. And beyond that, beyond paying down debt, you also have the opportunity to buy back shares and dividends.
One other point, some people have compared them to Berkshire Hathaway, the way they've kind of organized their operating structure. Maybe you comment on that. They're based in Sarasota, and they have a unique operating structure, which again keeps them similar to Church and Dwight, lean and mean, which makes them more competitive.
Yeah, so they don't have a bloaty head office, and they operate like Berkshire Hathaway in the way that they allow their businesses to operate very independently. There's not too much back and forth of head office and these companies. They do give them the ability to operate independently, and Roper might allocate cash here and there, but they get to operate. They know their end markets the best. Management stays not too involved in the businesses, except to help where they can. So they get to hobble together a bunch of fantastic businesses and allow them to really operate, because at the end of the day, that's why they purchase them, because they're fantastic businesses operating well already in their industries.
So what that does then is that the management of Roper is over top of all of these different software enterprises and businesses. And to the extent that they generate the free cash flow, if they can't reinvest it back in their business, then they ship it up to Roper at head office, and then Roper then can make the decisions what they want to do in terms of capital allocation. That's important because a lot of times if you just leave a lot of money in a company, they'll not be as prudent. They'll just continue to invest. But the returns on that new money going into the business become lower and lower. And so that's what Buffett has been able to do. Warren Buffett over at Berkshire Hathaway, he says, okay, I'll give you cash provided you can get a high return on it. If you can't, you give it back to me and I'll find a business that can get a high return on it. And so Roper's done an amazing job also at that, and it builds a discipline, a financial discipline for all of their subsidiaries and all the different software companies. And the compounding is just out of this world in terms of what they've done. So that's also important when we're looking at companies. Capital allocation. Do they have good margins? Do they have a moat around their business? And do they have opportunities to reinvest in the future? And they're disciplined. Because if they're disciplined, the returns are staggering. When Jesse was talking about GE, the comparison of GE and Roper, you can see just this massive difference when it comes to management's ability to do capital allocation. I'll leave you with one number as we just finish up the webcast. And if you think of Honeywell, we talked about Honeywell in a previous webcast, and it's one of our core holdings. And you compare that to GE, just over the last 5 years, Honeywell is up 90% and GE is down 60%. And these are two large industrial companies. You're thinking, how can Honeywell go up 90% and GE down 60%? That's a difference of 375% return. So if you had $10, it would be up to 19 in Honeywell, and that same $10 in GE would be down to 4. So 19 and 4 is a big difference. Capital allocation. It's all about capital allocation, the quality of the businesses, and making sure that you're in the right companies and you're allocating that capital efficiently for the highest rates of return. So that finishes up this webcast in terms of giving an update. Bottom line, let's be careful. Interest rates have come down a lot. Why are they coming down? A lot of pressure in the economy, concerns over debt. Let's make sure we're buying great companies, great businesses, strong balance sheets, companies that generate a lot of free cash flow and are essential. People need them. They're basic to our everyday life. And we can weather, I think, the ups and downs of the marketplace, keep a little powder dry, and be ready to act when values emerge. So thank you very much for listening. This is going to be on replay. And if you have any questions, comments, please send them in or give us a shout on the phone. You can Google us and get all of our coordinates. Thank you very much. We appreciate the support of our clients and look forward to serving you in the days, months, and years ahead. Thank you very much. Bye now.